The U.S. housing market isn't just slowing down, it's showing fracture lines that experts haven't seen since 2008. And this time, the warning signs aren't coming from subprime mortgages or reckless lending. They're coming from something far more structural and potentially more devastating. In the past year alone, foreclosure activity has surged 19% nationwide. Home insurance premiums have skyrocketed by up to 70% in disaster-prone states. First-time homebuyers now need to earn $126,700 annually just to afford the median home, while the average American makes only $84,000. And across the country, working families are being crushed by a perfect storm of rising costs that's making homeownership mathematically impossible. This isn't a prediction. This is already happening. From Florida's insurance market collapse to California's affordability meltdown, from rising foreclosures in the Midwest to debt-to-income ratios hitting crisis levels nationwide, the U.S. housing market is showing all 10 warning signs of an impending crash. Tonight, we reveal the data that real estate agents, economists, and homeowners are desperately trying to understand. Because what's coming next will reshape American housing for a generation. Stay until the end, because understanding these warning signs isn't just about protecting your investment. It's about understanding how the American dream of homeownership is being systematically destroyed by forces most people don't even see coming. Number 1. Foreclosure rates surging nationwide. Foreclosure activity has jumped 19% year over year as of October 2025, marking the 8th consecutive month of annual increases. In a single month, 36,766 U.S. properties received foreclosure filings, default notices, scheduled auctions, or bank repossessions. And here's what that means. Foreclosure starts, the initial phase of the process, rose 20% compared to last year. Completed foreclosures jumped 32% year over year. After years of near-zero foreclosure activity during the pandemic, the dam is breaking. Florida leads the nation with 5,512 foreclosure filings in a single month, one filing for every 1,829 housing units. Lakeland, Florida has the worst foreclosure rate in America, with one filing for every 470 housing units. California and Texas aren't far behind, with thousands of filings monthly. The drivers are clear: rising property insurance costs, climbing property taxes, inflation squeezing household budgets, and adjustable rate mortgages resetting at much higher rates. Homeowners with ARMs who locked in low rates during 2020 to 2021 are now facing payment shocks they can't afford. First Street research projects that foreclosure rates will increase by approximately 1% for every 1% rise in insurance costs. With insurance premiums soaring 30 to 70% in high-risk states, the math is devastating for homeowners already stretched thin. FHA loan delinquencies now exceed 11% and account for 52% of all seriously delinquent loans. These are mortgages that working families depend on: teachers, nurses, service workers, and they're defaulting at rates we haven't seen since the aftermath of the Great Recession. Legal requests related to foreclosures reached their highest level since April 2020 in May 2025. Families are calling lawyers in desperation, trying to save their homes from a convergence of financial pressures they never saw coming. If foreclosure trends continue accelerating through 2026, millions of American families face losing their homes not because of risky loans or speculation, but because the basic costs of home ownership have become unsustainable. Number 2, insurance market collapse creating uninsurability. The home insurance crisis has escalated from a regional problem to a national catastrophe. Florida homeowners now pay an average of $15,460 annually for property insurance, 4 times the national average. In some disaster-prone areas, insurance premiums now rival monthly mortgage payments. Nationally, home insurance premiums have surged 30 to 40% over the past 5 years. Single-family homeowners with mortgages pay an average of $2,370 per year for coverage, up nearly 70% from 5 years ago. And in high-risk states, the increases are even more brutal. California saw a staggering 34.58% increase in average annual premiums between 2024 and 2025, jumping to $1,976. Louisiana faces 28% projected increases for 2025. Michigan premiums rose 21.6% in a single year to $2,351. Iowa, Minnesota, and Ohio all saw double-digit annual increases. Since 2018, insurers have canceled nearly 2 million homeowner policies due to rising climate risks, 4 times the number normally expected in a year. Many cancellation notices came with little warning, leaving homeowners scrambling to find new coverage at sharply higher prices. In Florida alone, more than 30 insurance companies became insolvent, left the state, or pulled back operations during the height of the crisis. Major national insurers, State Farm, Allstate, Progressive, and Farmers have fled high-risk states or stopped writing new policies entirely. Citizens Property Insurance, Florida's state-backed insurer of last resort, carried over 772,000 policies as of September 2025, making it one of the largest insurers in the state. When the insurer of last resort becomes the backbone of the market, the entire system is on the edge of collapse. Florida's non-renewal rate for insurance policies jumped 280% between 2018 and 2023. California policy cancellations rose faster in some counties than almost anywhere else in the country. In Lake County, California, the only option for many residents is the FAIR Plan, which recently sought approval for a 36% premium increase. The insurance crisis operates as a slow-motion foreclosure crisis. When homeowners can't afford $10,000 to $15,000 annual insurance premiums on top of mortgages, property taxes, and HOA fees, they default. When buyers can't secure affordable insurance, they can't close on homes, killing entire real estate transactions. More than 70% of Florida homeowners have experienced rising insurance costs or coverage changes in recent surveys, including insurers dropping them entirely. The wealth effect from home equity means nothing if the home becomes uninsurable and therefore unsellable. If insurance costs continue climbing through 2026, vast swaths of coastal Florida, California, Louisiana, and Texas will become effectively uninhabitable for anyone except the ultra-wealthy who can self-insure. The American housing market will fracture into insurable and uninsurable zones, and millions of homeowners will be trapped on the wrong side of that line. Number 3. Affordability crisis reaches breaking point. The median home price hit a record $412,500 in 2024, a shocking 5 times the median household income. Traditional affordability metrics considered a price-to-income ratio of 3 acceptable. At 5, home ownership has become mathematically impossible for most working families. A home buyer today needs to earn $121,400 annually to afford a typical home, keeping monthly costs below 30% of income. The average American household earns approximately $84,000, leaving a gap of $37,400 or 44% more income required just to afford basic home ownership. Monthly mortgage payments on the median-priced home rose to $2,570 for first-time buyers in 2024, 40% higher than in 1990, adjusted for inflation. A buyer needs an annual income of at least $126,700 to afford this payment, plus taxes and insurance. Only 6 million of the nation's nearly 46 million renters can meet this income benchmark. For 87% of renters, homeownership is completely out of reach at current prices and rates. Not difficult, but impossible. Home prices have risen 60% nationwide since 2019, still climbing at 3.9% year over year as of early 2025. In 2024, the NAR Housing Affordability Index stood at 94.4. Below 100 means a typical family earning median income cannot afford the median-priced home. It's the worst reading in the index's modern history. In 1990, a whopping 75 metro areas had price-to-income ratios under 3. In 2024, only 3 metro areas remain affordable by that metric: Akron, Ohio, Toledo, Ohio, and McAllen, Texas. Everywhere else, housing prices have decoupled completely from local incomes. The median first-time buyer age increased to 40 in 2025, the highest on record and up from 31 in 2014. An entire generation is being priced out of homeownership during their prime earning years, forced to rent while watching wealth accumulation through property ownership slip away. Roughly 1/3 of all American households, including half of all renters, are now housing cost burdened, spending more than 30% of income on rent or mortgage payments. For 22.6 million renter households, housing costs consume so much income that basic necessities become impossible. Renters with annual household incomes under $30,000 have a median of only $250 per month left after paying for housing and utilities. That's $8 per day for food, transportation, healthcare, clothing, and everything else. It's not living, it's financial suffocation. If affordability continues deteriorating through 2026, home ownership will become a privilege reserved for the top 20% of earners or those receiving family wealth transfers. The remaining 80% will rent permanently, unable to accumulate the wealth that home ownership traditionally provided to American families. If you're still watching, here's the shocking twist. Affordability is collapsing, even in cities where prices are falling. Number 4, debt-to-income ratios approaching crisis levels. Household debt-to-income ratios are climbing back toward dangerous territory. Real estate professionals report approving tenants at 45 to 50% DTI ratios when they used to cap at 30%, a clear sign that financial stress is forcing acceptance of riskier borrowers. In 2008, average DTI ratios hit 43%, leaving borrowers vulnerable to payment shocks. Post-crisis reforms lowered the average to 35.5% by 2015. But by 2025, DTI ratios have climbed back above the 36% threshold considered healthy for financial stability. Total consumer debt in America reached $18.6 trillion in 2025, a 3.6% increase from the previous year, and the highest level since tracking began in 2003. Within that staggering total, credit card debt rose nearly 6% to a record $1.2 trillion. Americans now pay an average of $265 per month in utility costs, up 12% in a single year, adding to household expense burdens. Healthcare premiums for ACA marketplace coverage could jump from $888 to $1,904 annually if subsidies expire, while employer-based premiums rose 7% for 2026 plans. Serious delinquency rates, consumers at least 90 days late on debt payments, rose above 3% in Q3 2025. Credit card delinquencies hit 3.5%, while student loan delinquencies reached 20%, both up significantly from 2022 levels. Even non-mortgage debt is crushing mortgage payment capacity. When credit cards, student loans, and auto loans consume growing shares of household income, mortgage payments become impossible to sustain, even for borrowers who qualified originally. Credit scores fell by the most in 2025 since the Great Recession. As credit scores decline, borrowing costs increase. Lenders charge higher interest to compensate for greater perceived risk, creating a death spiral for families already struggling. The housing debt-to-disposable income ratio stood at 58.6% in Q3 2025. While well below the 90% peak that preceded the 2008 crisis, the trend is moving in the wrong direction. Even more concerning is mortgage rates averaging 6.5 to 6.7%, thereby eliminating refinancing as a solution for struggling homeowners. For homeowners who purchased since 2022 at elevated prices with 6 to 7% mortgages, there's no escape hatch. They can't refinance to lower payments, they can't sell without taking losses, and they can't absorb additional cost increases from insurance, taxes, or utilities. Truth is, if DTI ratios continue climbing while incomes stagnate and costs rise, we're heading toward a wave of strategic defaults. Homeowners who can technically afford payments but choose to walk away because they're underwater or the burden exceeds the benefit of ownership. Number 5. Record housing cost burden across income levels. A record 22.6 million renter households are cost-burdened as of 2023. 50% of all renters spending more than 30% of income on housing. For the third consecutive year, cost-burdened renters hit all-time highs, and the crisis is spreading beyond low-income households. The percentage of severely cost-burdened renters has increased in every income bracket over time. While the largest proportion earning under $15,000 remains severely burdened, middle-income renters are collapsing under housing costs. The percentage of renters who are cost-burdened with incomes between $45,000 to $74,999 has doubled to 45% since 2001. These are teachers, nurses, police officers, and service workers, the backbone of local economies, and half of them can no longer afford basic housing. Even households earning $75,000 to $99,999 face growing burdens, with cost-burdened renters in this bracket rising steadily. The affordability crisis is no longer confined to poverty-level workers. It's crushing the middle class. In 63% of U.S. counties, residents must spend at least one-third of annual income on housing. In nearly 20% of counties, housing costs consume 50% or more of income, leaving families with nothing for savings, emergencies, or basic quality of life. For the lowest income bracket, median housing costs rose 4% while incomes declined 9% between 2013 and 2023. The gap between housing costs and earning power is widening fastest for those least able to afford it. The rent burden falls unevenly along racial lines. Renter households of color are significantly more cost-burdened than white renters, perpetuating and deepening wealth inequality. White homeowners hold median equity of $82,000, 67% higher than black homeowners and 52% higher than Hispanic homeowners. Rental demand remains strong despite crushing costs because fewer households can afford to buy homes. The renting population grew by 848,000 in 2024, absorbing 608,000 newly completed multifamily units, the most developed in nearly 4 decades. But rental supply growth can't keep pace with surging demand. The number of higher rent units has increased while lower rent units have decreased, pushing affordable options out of reach for working families. Families that would historically transition from renting to ownership during their peak earning years are now trapped as permanent renters. Without home ownership, they can't build equity, can't benefit from price appreciation, and can't accumulate the wealth previous generations used to fund retirement or pass to children. If housing cost burdens continue spreading to higher income brackets through 2026, the entire economic foundation shifts. Families spending 40 to 50% of income on housing can't spend on retail, can't save for college, can't invest in small businesses, crushing consumer spending and economic growth across sectors. Here's the part real estate agents never want to discuss. Cost burdens destroy demand faster than interest rates. Number 6. Inventory normalizing. While demand collapses. Housing supply is increasing while buyer demand is falling, creating the supply-demand imbalance that precedes price corrections. Florida inventory more than doubled since early 2022, signaling market normalization that looks more like the beginning of a crash. As of September 2025, national housing supply reached 4.6 months. While still below the 6-month supply considered balanced, it's trending in the wrong direction for sellers. During the 2008 crash buildup, supply ballooned to 13 months, more than double normal levels. In Florida specifically, housing inventory climbed to an average of 54.8% in 2024. Average time on market grew by 11 days, year over year. Home prices fell by an average of 4.4%, one of the few states showing actual price declines rather than slower appreciation. Mortgage rates hovering around 6.5 to 6.7% have crushed buyer demand. More than 80% of existing borrowers are 100-plus basis points out of the money on their mortgages, meaning they have significant disincentive to sell and buy at higher rates. This lock-in effect artificially constrains supply from existing homeowners, while new construction adds inventory. The result is a frozen market. Existing home sales dropped to a 30-year low in 2024. Sales volumes have fallen so dramatically that real estate professionals describe markets hunkering down financially rather than making typical housing moves. Construction contractors report sizable discounts offered without pushback, indicating development pipelines are drying up. When contractors become flexible on pricing, it signals reduced activity that precedes market slowdowns. Commercial real estate vacancy rates compound the problem. Portland's downtown office vacancy rate climbed above 30%, one of the highest in the country. Empty towers in major cities drain tax revenues, strain municipal budgets, and create visible symbols of economic retreat. In vendor negotiations, suppliers of construction materials and signage offer major discounts, revealing that new development has stalled. When the construction industry itself pulls back, it eliminates thousands of jobs and removes economic activity that supports housing demand. The paradox: would-be sellers stay put due to rate lock-in, reducing traditional inventory. But new construction, distressed sales, and eventual forced moves from financial strain are adding supply. Meanwhile, buyers are disappearing, priced out by rates, prices, and economic uncertainty. Regional market imbalances amplify risks. Columbia SC saw speculative 8% home value growth on 1,830 units, while Sarasota FL experienced a 5% decline on 5,737 units. When some markets surge and others crash simultaneously, it signals chaotic correction rather than orderly adjustment. If inventory continues growing through 2026 while buyer demand remains suppressed by rates and affordability, the supply-demand imbalance will force price corrections, first in overheated markets like Florida and California, then spreading to metros that appeared stable. Number 7. Construction activity and new development stalling. The Legal Shield Housing Construction Index fell 4.1% in 2025 to its lowest level since March 2020, signaling that development activity is collapsing under economic uncertainty and foreclosure concerns. Rising interest rates have led to a spike in stalled private multifamily projects that are permitted but not yet built. Developers obtained approvals during low-rate periods but can't find financing or buyers at current market conditions. Construction phase financing has become prohibitively expensive. Banks typically offer higher rates and shorter-term loans that don't cover full costs, forcing developers to turn to private equity for even more expensive capital. Many projects simply can't pencil out economically. Tariffs on construction materials are estimated to add $10,900 to the cost of a new home. Combined with labor shortages, approximately one-third of construction workers are immigrants facing uncertain status. The industry faces a perfect storm of rising costs and shrinking workforce. Immigration policy impacts are real and immediate. Reducing immigration reduces labor supply in construction, potentially exacerbating the lack of affordable housing rather than solving it. The industry can't build its way out of the housing shortage without workers. New home sales increased only 3% in 2024, despite builders offering smaller homes, reduced amenities, and aggressive mortgage rate buydowns. Even with concessions, builder margins are compressed and sales volumes remain weak. The construction slowdown means the housing shortage, estimated at 3 to 4 million units nationwide, will only worsen. Meeting current demand would require building 4 million additional homes beyond current construction levels, according to Goldman Sachs estimates. When construction stalls, it doesn't just impact housing supply. It eliminates jobs, reduces consumer spending, and removes economic multiplier effects that support local economies. Every construction job supports multiple additional jobs in materials, transportation, retail, and services. Zoning restrictions and land use policies continue constraining supply in high-demand areas. About 75% of land in American cities is zoned exclusively for single-family homes, limiting density and affordable access to higher-income neighborhoods. Developers who would normally take risks on new projects are pulling back entirely, waiting to see if the market stabilizes or crashes. This wait-and-see approach means even when demand eventually recovers, supply won't be ready to meet it, setting up the next affordability crisis. If construction activity remains suppressed through 2026 while demand eventually rebounds, the housing shortage will intensify, creating an environment where affordability deteriorates further even after the current correction plays out. Number 8. Regional markets showing extreme stress. Specific metro areas are flashing red warnings of imminent collapse. Tampa, West Palm Beach, and Winter Haven show serious signs of slowdown with over 70% chance of price drops according to real estate professionals. Florida isn't in 2008 territory yet, but the combination of overbuilding, insurance chaos, and buyer burnout is creating a perfect storm. Cash sales and creative financing options like novations are helping sellers move properties fast before prices slide further. Denver could see a 10% drop in home values in certain submarkets by end of year if current trends continue. The signs point to meaningful price correction rather than full crash, but 10% declines wipe out years of equity for recent buyers. New York City metro area shows warning signs reminiscent of pre-2008 conditions. Debt-to-income ratios during tenant screening now reach 45 to 50% when landlords used to cap at 30%, indicating desperate acceptance of financially stressed renters. California and Florida lead the nation in high-risk counties for housing downturns. An Adam report identified 63% of counties where residents spend at least one-third of annual income on housing, with concentration in these two states. In high-risk counties, the combination of underwater mortgages, high unemployment, and soaring housing costs relative to income creates significant concern. Some California counties show housing costs exceeding 100% of average local wages, making sustainable homeownership impossible. Texas markets face dual pressures of property tax increases and infrastructure strain. Property taxes in Texas rank 6th nationally, with effective rates punishing homeowners as values rise. 3 of 5 metropolitan areas with biggest property tax increases between 2019 and 2024 are in Texas. Louisiana and Mississippi face population losses as residents flee rising insurance costs, climate risks, and economic stagnation. Louisiana lost more than 54,000 people in a single year, one of steepest declines in the nation, as insurance becomes unaffordable and flood risks intensify. According to First Street Foundation, 17% of all homes in coastal Louisiana face high flood risk over the next 30 years. Entire parishes could see neighborhoods erased by rising water, not a distant projection, but a current reality. The pattern is consistent. Markets that appeared strong are revealing fundamental weaknesses. Foreign investment created artificial demand. Short-term rentals removed housing from permanent inventory. Insurance market collapse makes properties unsellable, and working families are being systematically priced out. If regional stress continues spreading beyond obvious markets like Florida and California through 2026, the contagion will reach metros that appeared insulated. Because the underlying causes aren't regional, they're structural and national. Number 9. Economic indicators. Flashing recession warnings. The Mortgage Bankers Association reported upticks in serious mortgage delinquencies and foreclosure filings in Q2 2025, driven by economic weakness, stalling job creation, and rising unemployment. MBA Chief Economist Mike Fratantoni identified the core problem. Economic weakness is driving homeowners into trouble. People don't fall behind on mortgages unless they experience income loss, meaning unemployment must rise before foreclosure waves hit. The Urban Institute reports that 94% of mortgage defaults occur after homeowners lose income to extenuating circumstances. Job loss, reduced hours, medical emergencies, and business failures drive foreclosures, not speculation or choice. Economic uncertainty hangs over the market. Trade war impacts, potential tariff effects on construction costs, and weakening consumer confidence create an environment where families postpone major purchases, including homes, until clarity emerges. Consumer confidence surveys show declining faith in economic stability. When confidence falls, spending contracts and housing is typically the first major discretionary purchase that gets delayed or canceled entirely. The labor market shows cracks. While unemployment hasn't spiked dramatically, the slowdown in hiring and reports of rising layoffs in specific sectors suggest softening ahead. Tech layoffs, financial services consolidation, and retail closures all point toward economic deceleration. Traditional loan modification programs are failing at alarming rates. Since 2020, 13.7% of 1.24 million modifications have failed, with FHA loans failing at 22.1%. When government intervention programs designed to prevent foreclosure don't work, borrowers have nowhere left to turn. The percentage of Americans living paycheck to paycheck has increased steadily. Financial surveys reveal widespread pessimism about future prospects, with many reporting they couldn't cover a $400 emergency expense. Record household debt combined with rising interest rates on that debt creates a doom loop. Credit card rates averaging 20% plus mean families paying down debt with high interest have less money for mortgages. increasing default risk on housing debt. If economic conditions deteriorate into recession through 2026, unemployment will rise, incomes will fall, and housing defaults will accelerate. The current housing stress becomes an economic crisis when job losses force families into foreclosure who would otherwise have survived. This is where everything connects. The crash isn't about houses, it's about systems collapsing at the same time. Number 10. Systemic failures across multiple support systems. The final warning sign is the most concerning. Multiple systems that support housing stability are failing simultaneously. Insurance, infrastructure, healthcare, education, and government finances all show stress that compounds housing market vulnerability. Florida's citizens' property insurance exposure is staggering. With nearly 772,000 policies in force as of September 2025, the state-backed insurer carries risk that dwarfs its resources. A single catastrophic hurricane could trigger billions in claims and collapse the entire state insurance backstop. Infrastructure is crumbling nationwide. Jackson, Mississippi's water system failed so badly in 2022 that 150,000 residents went without safe drinking water. In 2025, the crisis persists. Temporary fixes keep taps running, but the system remains one breakdown from disaster. Municipal finances are stretched to breaking. Chicago faces tens of billions in unfunded pension obligations. Illinois carries a $140 billion pension shortfall. When cities and states can't fund basic services, property values collapse as residents flee dysfunction. School systems in struggling cities like Baltimore, Cleveland, and Birmingham report chronic underfunding and performance so poor that proficiency rates in math and reading fall below 10% in some districts. When education fails, families with means leave, hollowing out tax bases further. Healthcare access disparities worsen housing stability. Alabama has lost 7 rural hospitals since 2010. Pennsylvania rural hospitals close at alarming rates. When the nearest emergency room is hours away, property values plummet and communities become unlivable for aging residents. Climate disasters are becoming more frequent and severe, with 10 of the 20 largest California wildfires occurring in the last 5 years. Hurricane damages in Florida from just the last 7 years exceed $300 billion. The frequency and severity of disasters is outpacing society's ability to rebuild and recover. State and local governments face mounting pressure to address housing crises with declining federal support. Budget cuts proposed in the Trump administration's fiscal year 2026 budget request would deepen affordability crises by removing support for millions of households. The safety nets designed to catch failing families and markets are themselves failing. When insurance, infrastructure, healthcare, education, and government finances all deteriorate simultaneously, there's no backstop left to prevent housing market collapse. These aren't isolated problems, they're interconnected system failures that amplify each other. Insurance collapse drives foreclosures. Foreclosures reduce tax revenues. Reduced revenues mean worse infrastructure and services. Worse services drive more people out. More exodus worsens remaining conditions. If systemic support failures continue accelerating through 2026, the housing market doesn't just correct, it transforms into a humanitarian crisis where millions of families lose shelter, wealth evaporates, and entire communities become economically unsustainable. In conclusion, from surging foreclosures to insurance market collapse, from unprecedented affordability crisis to regional stress intensifying nationwide, these 10 warning signs aren't predictions. They're current realities. The U.S. housing market has entered dangerous territory, not because of reckless lending or speculation like 2008, but because the fundamental economics of homeownership have become unsustainable for most American families. When teachers need $126,700 to afford median homes. When insurance costs $15,000 annually in Florida. When 50% of renters spend over 30% of income on housing. When foreclosures surge 19% year over year. When construction stalls and inventory piles up. When entire state insurance markets teeter on collapse. These aren't individual problems. They're interconnected warning signs of systemic breakdown. The cruel irony is that this housing crisis emerged during a period of economic growth, low unemployment, and rising stock markets. The crash isn't coming from external shock, It's building from internal contradictions, where costs rise faster than incomes, where climate risks outpace insurance capacity, where housing demand meets insufficient supply and excessive prices simultaneously. The 2008 housing crash was sudden, triggered by mortgage defaults that cascaded through the financial system. This crash is slower, more grinding, and potentially more devastating because the problems are structural rather than speculative. You can't fix this with lower interest rates when insurance costs $15,000 annually. You can't solve it with more construction when zoning prevents building. You can't address it with better lending standards when incomes are too low to support any mortgage. The American housing market faces a reckoning. The question isn't whether adjustment comes. It's whether the correction is orderly or catastrophic. Whether families lose homes they could have kept if policy changed. Whether communities become uninhabitable, not from disasters, but from costs. For millions of American families, the crash has already started. The foreclosure notices have been sent, the insurance policies canceled, the moving vans loaded, the dreams of homeownership abandoned. The 10 warning signs are here. The question is whether we pay attention before the damage becomes irreversible, or whether we watch America's housing market collapse one family, one neighborhood, one region at a time. Because the U.S. housing crash isn't coming. It's already begun, and the consequences will reshape American society for generations.